Welcome back to Accounting 201. Today we're going to look at inventory, and for this chapter I'm going to break the video up into two parts just to keep them manageable lengths. So let me start with a screen share real quickly over here. Once again, we are using the PowerPoint that comes with our textbook, and I've modified this to suit this video. So let's start with the learning objectives. In this video, we're going to look at classification of inventory and how we determine what should be or should not be counted in inventory. And we'll look at various cost flow methods and discuss their effect on the financial statements. The third learning objective I'll take care of in the next video. So let's start with what is inventory and how it is reported in the financial statements. Your business could be one of three types. It could be a service business, a retail or merchandising business, or a manufacturing business. In this chapter, we talk about only the merchandising business and the manufacturing business. A service business does not have any inventory, therefore we don't talk about that over here. The difference between these two are a merchandising business is basically a retailer who buys finished goods and sells the finished goods without doing anything else to it. A manufacturing business, on the other hand, will buy raw materials, work on it, change its shape and form, and make a finished good which they then sell, typically to the retail business. So for a merchandising business, they have inventory only in one form, the merchandise inventory. For a manufacturing business, it could be in three forms: raw material, work in process, or finished goods. When you get to your second accounting class, in Accounting 202, you will learn a lot more about manufacturing businesses and how you calculate these dollar amounts. For now, we're not going to worry about it. We're focusing only on our merchandising business. For both of these types of businesses, where are we going to report the inventory? It's always listed in the balance sheet under current assets. Recall the definition of a current asset. Current assets are those assets we expect to convert into cash or use up within the next 1 year or the operating cycle, whichever is longer. I certainly hope to sell my inventory within the next 1 year. Therefore, it's going to be classified as a current asset. Now, the next step we need to look at is why do we actually count the inventory, and then how do we count the inventory? So for the first part, why do we count inventory? We need to do a physical count of inventory. If I'm using the perpetual inventory system, my books at any given point of time tell me what my inventory is, but that may or may not be what's out over there. So I want to check the accuracy of my inventory records. And why would there be a discrepancy between what my books say I have versus what I physically, when I count, I see I have something different? Usually it's because some raw material may go to waste. There could be shoplifting, customers steal, employees steal. So when we get to the next chapter on internal control and fraud, you're going to see that this is a huge problem. But for now, what we're saying is, even if you have perpetual inventory system, your books tell you what you have, you still need a physical count. In the periodic system, my books at no point of time tell me exactly how much I have in inventory. I need to count it to determine the inventory on hand. Also, I need to calculate the cost of goods sold. Therefore, I need that information. So for a variety of reasons, as you can tell, we need to do a physical count of inventory in addition to having our accounting records. Now, how exactly do we count inventory? You have to actually do the physical count. You have to weigh the inventory in some cases, because if a bag tells me I have 10 pounds of product X, do I really have 10 pounds in that bag, or is it mislabeled? I need to actually check. I may have to measure the inventory. If it's fabric, I may have to actually physically measure how much inventory I have remaining on hand. This is something auditors will do in order to make sure that a company is not lying about what they say they have an inventory. And when do we do this? It's usually done when a business is closed or at least slow, which means you don't want too many customers around over there, because you don't want to affect your sales. You don't want customers to be hindered in any way in making their purchases. Also, this is done at the end of the accounting period typically, end of the month, end of the quarter, end of the year. So we do need to do a physical count of inventory. Now, having looked at that, let's move on and see what items I would include in the inventory. Just because I physically have it with me, I may not include it in my inventory, doesn't mean I have to. And just because I don't have it, doesn't mean I should not include it. So what is all this cryptic talk about over here? What if goods are in transit? A seller has sold the inventory to the buyer. It's in transit. Who includes it in their inventory? The buyer or the seller? So goods are purchased, not yet received. Goods are sold, not yet delivered. So we have all these kind of different scenarios we're going to look at. So goods in transit, when they're in transit, it should be included in the inventory of the company that has legal title. Whoever is the owner during transit, they're the ones who include in their inventory, even though they don't physically have it. So if you can recall from the previous chapter, we had seen the slide, free on board shipping point, free on board destination. We had talked about who pays for the freight. Really what we said there was whoever is owner during transit pays for freight. And same thing goes over here. Whoever is owner is going to include it in their inventory even though they don't physically have it. So it's free on board shipping point. As soon as the seller gives it to the shipping agent, they have passed the title on to the buyer. So during transit, the buyer includes it. So if it's free on board shipping point, the buyer includes it even before it gets to them. Free on board destination, only when the shipping agent gives it to the buyer, that's the buyer gets physical custody. Until such time, the seller is still the owner, which means if it's free on board destination, while it's in transit, the seller still includes it in their inventory. So what you've seen here is, in both these cases, neither the buyer nor the seller has physical custody of the goods, but one of them has to include it in their inventory. Okay. Having seen that, let's look at another type of situation, consignment goods. I'm sure you've all heard about consignment stores. Most common thing we hear about is people selling their clothes through consignment. So how does that work? So in consigned goods, you've been asked to hold goods for other parties and to try to sell the goods for them, and you make a fee. You never take ownership of the goods. So what does this mean? Let's kind of break it up and see who are the three parties involved in this transaction. You have the consignor, the owner of the goods. So I have clothes I'd like to sell. I take it to the consignment shop. That's called the consignee. The consignment shop is a consignee. They're just a selling agent. The key word is an agent. They're not buying the goods from me. They're just going to sell it for me. They have physical custody of the goods, but they're selling it for me. The customer is the one who's going to finally buy the goods and get ownership. So while the consignee is holding the goods, the consignor will still include it in their inventory. Even though they don't physically have it, they include it in their inventory. So keep that in mind when you work through certain exercises and see who has title during transit. Are these goods on consignment? Am I the consignor or the consignee? Consignee never keeps that inventory in their books. It's a consignor who keeps it all the way until the consignee tells them that I have sold the goods for you and I'm sending you the cash. Until such time, they still have to keep it in their books. Okay, so let's see what's next over here. Inventory is accounted for at cost. Remember, we use the historical cost principle. We want to go with whatever we bought it for. It's going to include all expenditures necessary to acquire the goods and place them in condition ready for sale. So basically, in a retail business, what you're looking at is the cost of the goods that you paid, what you paid for it, the invoice price. If you paid for any shipping, you paid for insurance during transit, all of that gets included in the cost of the inventory. Unit costs are applied to quantities to determine the cost of inventory, the total cost of inventory, and the items sold. So this is pretty straightforward, but it depends on which cost flow method we're going to use. So let's look at the costing methods that we have. We could use specific identification, first in, first out, that's the FIFO method, last in, first out, LIFO, or an average cost method. These three methods are basically cost flow assumptions. How the cost is flowing through from the company from the time they buy it to the time they sell it. How that happens. Okay, so let's take an example and work through the four different costing methods that we have, cost flow methods. So let's start with specific identification. Actual physical flow, what you're concerned with is you identify the individual item that you have sold. You know exactly which piece you've sold. You know how much you had paid for it. Therefore, you know the cost of goods sold. So actual physical flow costing method in which items still in inventory are specifically costed to arrive at the total cost of ending inventory. In reality, this practice is relatively rare because it's really going to be time consuming. So who would possibly use it? What type of inventory do you need to have? If it's a high priced item and low in volume, then you're going to know every single item that you have. So classic examples are your jewelry stores. Even at a mall, the jewelry store, if they have high-end items, they're going to do specific identification. A car dealership, antique dealers, those items are unique. So that's why you would do that. So it's relatively rare. We are not talking of run-of-the-mill retailers. Most companies make assumptions, cost flow assumptions about which units are sold. They're not going to bother with specific identification. However, we will go through one example just to see what it looks like. Okay, so let's take an example. We're going to use the same example for all four methods. I made 3 purchases. I purchased 3 televisions. The first one I paid $700. The second one I paid $750. The third one I paid $800. This is my inventory. I have 3 units of television. On June 1st, I sold 2 of those 3 televisions. The selling price is $1,200 a piece. But this doesn't tell me what the cost of the inventory is. So which of these 3 did I sell? If I'm using the specific identification method, I need to know exactly which of these I sold in order to find out what my cost of goods sold is and what's an ending inventory. So of 3, if 2 are sold, 1 is remaining. So let's look at this example. Here we are told that the first one that was $700 was sold. The last one that was $800 was sold. Therefore, the one that's remaining with me is $750. So cost of goods sold is $700 plus $800. That gives me $1,500. And ending inventory is $750. So quite literally, if you look at the picture, you can get the calculations fairly straight over here. So there is no confusion about which one is remaining and which ones are sold. So once again, if it's high price, these are unique items, low in volume, you can do it. Otherwise, it's going to be cost prohibitive just to do the accounting. So now let's take a look at the first in, first out method. The cost of the earliest goods purchased are the first to be recognized in finding out your cost of goods sold. So basically, first in, first out, what it means is whatever came into the business first, whatever I purchased first, that's the one I'm selling first is the assumption. For several inventory items, this makes a lot of sense. In fact, probably for most inventory items. But the best example you can think of is a grocery store. Whatever they bring in first, they're going to sell first because these are time sensitive. They're perishables. The longer they keep it, it's going to go bad. They won't be able to sell it. Therefore, they need to push that merchandise fast. So it often parallels the actual physical flow of merchandise. So it's a very common method that's used. Companies determine the cost of ending inventory by taking the unit cost of the most recent purchase and working backwards until all units in inventory are costed. So this would be in the periodic method. You could do this, and even in the perpetual method. So let's take a quick look at the same exercise, the example that we looked at earlier. I'm using first in, first out. Which came in first? The $700 that was purchased on Feb 3rd, then March 5th, and then May 22nd. So when I sold 2 pieces, which ones did I sell? I sold this one, and then I sold this one. What's remaining with me? The last one is remaining with me. So cost of goods sold is $1,450. ending inventory is 800. Again, given the small example that I have on hand, doing this calculation is very easy, but actually it makes sense doing it with a small example and extending it to larger examples. Okay, last in, first out, same example we're going to work through. So costs of the latest goods purchased are the first to be recognized in determining cost of goods sold. Now, what type of merchandise would this make sense for? We're saying that whatever came in right now, that's the one I want to sell first. I'm not interested in selling the older merchandise. I'm interested in selling the newest one. That's typically the case if I can get a much higher selling price. I can sell it for a much higher amount if it's the newest item. So this is true for technology. When you're looking at your phones, new iPhones coming out, they can charge a premium for it simply because everyone wants it. New televisions, new computers, any of the technology, also fashions, they're seasonal. They want to sell those items because within a month or two, it's probably going to be at a half the price. So it does make sense in some cases to use last in, first out. For a lot of items, it doesn't match the physical flow, so which is why you have to be very careful when you're going to choose to use this method. An example they've given you where it would work, where this would absolutely make sense is if you were to go by places that have coal, like in Baltimore, you would see that whatever is stacked up on top is the first to be taken out, simply because physically it's hard to get to the old stuff. You see the mountains of salt that they have in Baltimore. Any of those are examples. So these are more the industrial examples, or hay on a farmland if you're looking at that. So in those cases, it makes sense. So it has to be something that actually mimics reality for you to use this method. We are going to see why a lot of firms use last in, first out, even when it does not parallel the reality of what they actually do. Okay, let's go back to our example again. I have 3 purchases, and then on June 1st, I made a sale of 2 units. I'm using last in, first out. Which ones did I sell first? I sold the TV I bought on May 22nd, and I sold the TV I bought on March 1st. At the end of the period, what's remaining with me? That old TV from Feb 3rd, it's still remaining with me. So cost of goods sold now is the $750 and $800, which becomes $1,550. And what's remaining with me? Ending inventory. That old TV, $700, is still there with me. Probably that value has gone down even more from that now. Okay. So we've looked at these different examples. Now let's move to the last method, and that is average cost. Average cost is, again, if the inventory demands that we use this method, it makes sense, then that's the one we should use. And let's take a look at what it is. You allocate the cost of goods available for sale on the basis of weighted average unit cost. You apply the unit cost to units on hand to find out what the ending inventory is. Let's go back to our example. On June 1st, when I made the sale of 2 units, how many units did I have on hand? I had 3 units, 1, 2, 3, I had 3 units. What was the total I paid for them? I add up these 3 numbers and I divide by 3, and that'll tell me what the average cost of my inventory is. So the average cost is 700 plus 750 plus 800 divided by 3. That's 2250 divided by 3, and that works out to 750. So cost of goods sold, I sold 2 units. 2 at 750 is 1500. I have 1 remaining with me. 1 at 750 is 750. So it's fairly simple. Now, under what circumstances would this make sense? What type of inventory? Best example I can give you is if you look at a gas station. Where do they store their gas? Underground. They have huge tanks underground. Let's say a gas station, high volume gas station, they bring in 10,000 gallons of gas the first time. That's their capacity. And on the very first day when they have 10,000 gallons, they sold 9,000. 1,000 is remaining. At the start of the second day, they got a refill, they got 9,000 gallons. Now, the next second day too, when they sell gas, did they sell the 1,000 that was remaining from yesterday or the 9,000 from what they purchased today? They can't distinguish between the gas that was there from yesterday and today because it's all mixed up. average cost makes the most sense for them. And also the variation in price is not that great for that type of inventory. It constantly changes, but it's not a big change. Therefore, the average cost method makes the most sense. Now, if you recall again from the previous chapter, cost of goods sold is an expense. It goes in your income statement. So we'll take these numbers, the cost of goods sold numbers that we calculated. In all cases, the sales is the same, 2,400. That's not going to change. Cost of goods sold is going to be different in each case. And let's work through the effect on our financial statement. That's the income statement. Okay. So sales less cost of goods sold gives me gross profit. Gross profit less operating expense gives me operating income. And then my income tax expense, I'm assuming a 20% tax rate. When I subtract that, it's going to give me my net income. So in all four cases, sales is 2,400. Cost of goods sold, depending on which method I used, I came up with different numbers. Therefore, gross profit is going to be different. I assumed I have $300 in operating expense in all three cases. Yeah, it has to be the same. Operating expense is not going to vary based on the costing method I use for inventory. So my operating income now is different. It's really because my gross profit was different. And based on that, my income tax expense number is going to be different. So specific identification, really, let's set that aside because it is what it is. For these three methods, let's see what the pattern is. So first thing, regardless of what we're looking at, your average cost method will give you a net income number that's going to be between LIFO and FIFO. It's going to be between these two. If the prices are rising, as they were in this case, the first TV was 700, the second was 750, the third was 800. See what happens over here. Last in, first out. Okay, so I'm going to show you the cost of goods sold, how it was calculated, and what the effect is over there. Cost of goods sold for this method, you specifically knew which ones they were, but this is what we're concerned with. Cost of goods sold in last in, first out. The last units were the ones that were sold, the more expensive ones. Therefore, my profit is lower. If I use the first in, first out method, the amount that I expensed, what became cost of goods sold, was a less expensive inventory, which is resulting in a higher, and it's exactly $100 difference. You're going to get the higher net income, operating income over here. And I already told you that this is going to be somewhere in between. Again, so let's focus on our LIFO and FIFO over here, these two. Now, FIFO reported a higher profit, therefore they pay more in taxes. LIFO reported a lower profit, therefore they pay less in taxes. The tax number that they report is going to be smaller over here. So keep in mind, I had mentioned that although FIFO makes the most sense for most businesses, there are some businesses that choose to use LIFO, and this is the reason why they would use LIFO, the tax effect. So that is a really big deal for a lot of companies, and in the next slide you're going to see how we allow it and some others don't, and we'll see who those some others are. Okay, so in periods where prices are changing, you're going to have an impact on the income and evaluation of income as follows. So let's look at what happens if during period of inflation. The example we looked at, it was inflationary. The first TV was 700, the second was 750, the third was 800. FIFO is going to produce higher net income because lower cost of units that are purchased are matched with revenues. Again, during period of inflation, LIFO is going to produce lower net income. We just went through that example. In the period, if the prices are falling, the opposite is going to be true in terms of who produces a higher net income. Regardless of price are falling or rising, average cost will always be between the LIFO and the FIFO number. So it's really interesting to keep this in mind because this kind of dictates a lot of how companies make choices in accounting. It's just numbers, but those numbers can be quite dramatic in terms of how it affects companies and their performance and the expectations of the stock market. Okay. So the cost flow assumption does not need to be consistent with the physical movement of goods. A company has a choice. They choose whether they want to use a perpetual or the periodic system. Within that, they then choose, do they want to use which costing method they want to use. Specific identification, LIFO, FIFO, average cost, it's their choice. Okay, so if you look at a recent survey, 45% of the companies in the US use FIFO, 24% use LIFO. It may not really be the reality of what happens, but there's a reason why they're using LIFO. 16% use average cost, and 15% use other methods. Specific identification is one we've looked at. There are a few other methods, but not as popular, so we don't go over those for now. But again, FIFO is the most popular method, as it should be. Okay. Methods should be used consistently because it'll enhance comparability. If I use the same method from one period to another, it's going to help me. Okay. All the consistency is preferred. A company is allowed to change the inventory method, as they've given you an example over here. Companies would change a method for two of the most common reasons cited why a company has changed a method is, the first one is it's a relatively new company and the method they chose originally was not the appropriate one. And they decide, this doesn't make sense, I need to switch. That obviously is a wise thing to do. A second reason why a company may switch a method is if the industry leader, the largest company in the industry, chooses a different method, everyone within that industry will switch to that other method so that they can have comparability. So they forgo consistency in order to get comparability with the other companies. But again, it's very rare that a company will make a switch. But yes, they are allowed to make the switch. That's something to keep in mind. Now, I mentioned that some companies will choose to use LIFO, and I told you some others don't, and the some others I'm really referring to now are the foreign companies. IFRS is International Financial Reporting Standards. The rest of the world, other than the US, a large majority of countries use IFRS. They follow a common set of accounting rules. Here we follow US GAAP. So what's the difference? The US GAAP is more rules-based, while the IFRS is more principles-based. We have a lot more guidelines for inventory management. If you're an accounting major and get to intermediate accounting, we have 2 full chapters devoted on that, just for this inventory valuation. Another major difference is this LIFO that I kept talking about. GAAP allows LIFO. That's in the US, we allow LIFO. The IFRS prohibits its use. It is not allowed. No other country in the world that follows the IFRS rules, which is a majority of them, they don't use LIFO. So even US companies, they have a heavy burden if they want to list in a foreign stock exchange because they have to redo their financial statements. So LIFO and average cost are the only 2 acceptable cost flow methods under the IFRS. Both permit specific identification if it is appropriate. So it's very rare, but if it's appropriate, it's allowed. But LIFO, that's a problem. We over here allow it, no one else allows it. So just keep these issues in mind anytime you're thinking about a global company. And in this day and age, everyone is doing global business. So more and more companies are choosing to give up LIFO for that particular reason. So this concludes the first part of the video. And the second video that we're going to have for this chapter is going to deal with learning objective number 3.